How's it going, everyone? Welcome back to the program. Today we've got Richard Duncan, who is a former IMF consultant, authored several books, including The Dollar Crisis, which is absolutely fantastic. It also very accurately predicted the global economic disaster. And Richard has been a guest on this program several times before. We'll link to all those in the show notes page. And I want to just mention before we jump into this, there are very few economic subscription models that I'm a big proponent of, and this is one of them. Richard at richardduncaneconomics.com, he's got something called Macro Watch. He actually just sent me over a couple of slides that are available on that program or behind the paywall. And there's a reason that I was very excited to get this email from him that said, look, Hunter, we got to talk about this. Here's a PDF of a recent thing I did. Let's jump on the show and do it. And I said, anytime, doors always open for you. So Richard, thanks so much for coming on.
Hunter, it's great to be back on. Thank you for inviting me back.
So I have, for whatever reason, well, I know a reason, I can give you about 2 trillion reasons. I have been getting a lot of questions about the future of the economy, the future of real estate, the future of interest rates, and most importantly, what all of this liquidity means for things like asset price inflation, CPI type of inflation, how most people think of inflation, and also how that relates to interest rates. I'm very much looking forward to this conversation. Before we jump in, let's talk about that liquidity that was created and kind of give us a perspective from either historical standard or otherwise, what this means and how significant this is over the last year or so.
Okay, well, your listeners are probably aware that the Fed is now creating $120 billion every month and pumping it into the financial system by buying government bonds and mortgage-backed securities. So that's 120 billion is a lot of money. If you multiply that times 12 months, that's $1.4 trillion. So that already is an enormous amount of money going into the markets and into the economy. But there is something else that's really unique that's happening at this point in time as we speak that I think very few people are aware of. Let me explain this. The Treasury Department, which of course takes in money from taxes and by selling government bonds, and then it spends the money on all the things the government spends on. So it carries out the spending of the government. Now, the Treasury Department has a bank account at the Fed. And going back a couple of decades, this really wasn't a big deal because there was not very much money in this bank account. The money would come in, the government would spend it right away, and it didn't really have very much of an impact on anything. But last year, this changed just extraordinarily. At one point at the peak, the government had $1.8 trillion in its bank account at the Fed. Now, this is very important because that actually sucked money out of the economy. Because let's go through this. How did the Treasury get so much money in its bank account? Well, this is what happened. Back in March last year, the government passed the CARES Act, the first big stimulus bill. And immediately after that, most people assumed that there would be a second very large stimulus bill passed quite quickly. In fact, the House of Representatives passed a $3 trillion stimulus bill, the second one, but it didn't make it through Congress. But the Treasury Department, expecting, like most people, that there would be a new big stimulus bill, they started raising money. They started selling a lot of government bonds so they would have enough cash on hand so that when the stimulus bill passed, that they could spend the money in a timely way. So they sold a lot of bonds, but the stimulus bill was never passed until the middle of December. And when it was passed, it was only $900 billion instead of $2 or $3 trillion as people had expected. So the Treasury had built up an enormous war chest that peaked at $1.8 trillion. Now, when the Treasury borrows money and puts it in its bank account and doesn't spend it, that sucks money out of the economy and out of the financial markets. You could think of this as kind of the opposite of quantitative easing. But now everything has changed because the new stimulus bill, well, we did get the $900 billion bill in December, and now we have a new $1.9 trillion stimulus bill just passed very recently. And so now the Treasury Department is spending down this money in its bank account. And as it does, that's injecting an extraordinary amount of additional money into the economy on top of what the Fed is doing. So the report that I sent you was based on information from February 24th. At that time, the Treasury Department, every 3 months, announces how much money it's going to borrow, and also it announces how much money it expects to have in its bank account at the Fed at the end of every quarter. And so what they said at the beginning of February is that they were going to run down the money in their bank account to $500 billion by the middle of June, by the middle of the year. So we knew the amount of money they had in their bank account on February 24th. It was $1.4 trillion, a little bit more than that. And so that meant if they actually carried through and spent the money in their bank account so that the balance ran down from 1.4 trillion to 500 billion, that would mean the injection of more than $900 billion into the economy just over the next 4 months, between now and the middle of June. So not only did you have the Fed creating $120 billion a month times 4 months, that's $480 billion, but add to that another $900 plus billion from the Treasury spending down its money in its bank account. And so, that's roughly $1.4 trillion injection of liquidity in just a very short period of time. And that would all flood into the financial markets. It would be reflected in the level of bank reserves. Bank reserves are one measure of liquidity. And based on what I've just said, the combination of quantitative easing and the Treasury running down the money in its bank account, that meant that between February 24th and June 30th, the amount of bank reserves would increase by 39%. So this is just a tsunami of liquidity hitting the financial markets right now. And it has the potential to, it's not surprising that the stock market has hit new highs again and again in recent weeks. And of course, there's already a speculative frenzy going on in the markets. And this explains it. And it looks set to carry on at least until the end of June.
Walk us through how the flow of funds, right? So the bank reserves increase. What happens from there? How does that almost instantly create, either directly or indirectly, that asset price increases across the stock market and potentially otherwise?
Okay, so the concept of bank reserves is very confusing for most people. But just imagine it this way. As I mentioned earlier, the Treasury Department has a bank account at the Federal Reserve, but every bank does as well. And if you add all the bank accounts at the Fed together, that is equal to total bank reserves. And so if we're talking about a 39% increase in total bank reserves, that means that the banking system will have an increase in their deposits at the Fed that will jump by 39%. So how does this affect the stock market? So, this is how it works. Let's use the example of the Treasury. So the $1.9 trillion stimulus bill has passed. They've started sending out the checks, $1,400 checks to most Americans over the last 7 days. So those checks go from the Treasury's bank account at the Fed straight to Americans. What do they do with it? Well, that's up to them. But the first thing they're going to do with it is deposit it into their bank account. And so that increases the amount of deposits the banking system had. And now the individual who receives the $1,400, he can do anything with that money he wants to. He can punt on GameStop. He can pay down his debts, or he can buy a house. But regardless of how he spends that money, it's going to go to another person. And that other person, initially at least, is going to deposit it back into his bank account. The money goes into the banking system and it stays there. And so what this means is that the level of money in the banking system is set to increase by 39% between now and the middle of, by the end of June, the middle of the year. So of course, it's not surprising when the amount of money in the banking system increases by such a large amount in such a short space of time, that asset prices would tend to move up. The more money there is in the system, the higher asset prices tend to go. And we've seen this again. If you compare the increase in bank reserves with a chart of the S&P 500 index, every time bank reserves go up, the S&P 500 goes up. We saw that beginning after the crisis of 2008, with the first round of quantitative easing, the second round, the third round of quantitative easing, and then more recently, the response to the pandemic. Every time the Fed injects a lot of money into the financial system, bank reserves expand and asset prices inflate. And so we're looking at a period now, just over the next few months, where, for the reasons I've just explained, the Treasury running down its bank account and the Fed creating so much money through quantitative easing, we're being hit as we speak with a tsunami of liquidity going into the financial markets.
So here's a question. There's several of these that I've been looking forward to asking you, but this is one that I'm very much interested in and do not have a good answer for. But why does there appear to be such a pronounced delta between asset prices and inflation? And do you anticipate that that delta will continue, or is that something that's unique that would likely be a short-term type of thing?
You mean in terms of the
asset prices versus CPI?
Okay, well, there doesn't seem to be very much connection at all between asset price inflation and CPI.
That's my point. I mean, I think most people would think, okay, you print money, you could see how real estate and stocks would go up, but you would anticipate that this cost of living would also go up over a long term, maybe a one-to-one kind of basis. But that isn't happening at all. I was hoping you can kind of clarify why that is and whether or not that would be something we should expect in the future as well.
Okay, well, so in the past, that was true. If the government spent too much money and the Fed created a lot of money and flooded the financial system with new liquidity, that did tend to generate high rates of consumer price inflation. But that relationship has entirely broken down since the early 1980s. And the reason is because of globalization. Up until 1980, 1981, the US did not have a trade deficit with the rest of the world, or it was so minor you can barely see it on the charts anymore. And that was because up until the breakdown of the Bretton Woods system in 1971, trade between countries had to balance because money was backed by gold. And if one country had a big trade deficit with another country, it had to pay for its deficit by sending its gold to another country. And if it lost its gold, it meant it lost its money. So its economy went into depression and it stopped buying things from other countries. And trade came back into balance back then. And that's the way international trade worked up until 1971 when the Bretton Woods system broke down. But after it broke down, money was no longer backed by gold or anything else. And the United States, after a little while, discovered that it could buy things from other countries and it could just pay with paper dollars, or more realistically, treasury bonds denominated in dollars. And so beginning in 1980, the US trade deficit started to explode for the first time in history. It went from 0% of GDP in 1980 to about 3.5% of GDP in 1985 or 1986. And then by 2006, this had blown out to 6% of GDP, $800 billion in 1 year alone. So this fundamentally changed everything in the US economy and the global economy and how economics works and how we should understand economics. The classical economic textbooks were written at a time when gold was the foundation stone of macroeconomics. But once that foundation stone was removed, everything changed. So up until we started running these trade deficits, if the government spent too much money and the Fed created too much money, that would overstimulate the United States economy. The United States only had a certain number of people in the workforce. And if you stimulated the economy too much by big budget deficits and paper money creation, all of those people would have had jobs. And moreover, the country only had a certain number of factories to make cars and steel. All of those companies would be working at full capacity. And pretty soon that stimulus would lead to bottlenecks, not only in industrial capacity, but in labor. So we would start to see prices go up for steel and automobiles and everything else. But most importantly, wage cost would go up. There would be a bidding war to hire workers because there were too few workers relative to the amount of demand that was being created by the government spending. And so that led, particularly in the 1960s and first half of the 1970s, that's what we witnessed. We had what is now known as a wage push inflation spiral, where wages started moving higher every year and prices of other consumer goods would move higher every year. And so when the workers would renegotiate their wage packages for the next year, they would demand that they would automatically get a 6% pay increase, 8% pay increase to keep pace with the inflation rate. And so that caused double-digit inflation in the early 1970s. But then the world changed entirely. You can think of our economy at that time as a fish being in a fish bowl. there were walls around the fish that limited what fish could do. But the fishbowl was then dropped into an ocean. Instead of having a population of 330 million people, as the US does now roughly, now our economy is comprised of nearly 8 billion people. And almost all of them earn far less money than the average American. Still, 2 billion people live on less than $3 a day. So this completely changed the environment in which our economy was operating. We were no longer constrained by domestic bottlenecks in labor and industrial capacity. Suddenly, we had a whole world full of people willing to work for $10 a day, an infinite supply of low-cost labor. And at that point, wages in the US stopped going up. And consequently, inflation in the US came to a standstill. The inflation rate dropped from double digits. Now the Fed is struggling for decades to meet its 2% inflation target. It can't make inflation grow by 2%, no matter how hard it tries. That seems to be what we've seen over the last couple of decades. The Fed's favorite measure of inflation is called the core PCE price index. That's the core personal consumption expenditure price index. It's core because it strips out food and energy prices, which are very volatile. And its target is to have 2% core PCE inflation every year. But going back to the year 2000, this has averaged 1.7% a year. And from 2010, it's averaged 1.6% a year. And right now, it's 1.5%. So the Fed has not been able to make inflation go up as much as it would like for it to, despite these extraordinary rounds of quantitative easing that we've seen starting in 2008. And despite the $1 trillion budget deficits our government has run again and again since 2008. So that's what's changed. That's why we don't have inflation, because our environment has changed. We have moved from having a very small, closed domestic economy to now we have the whole world. And so we can run the US economy hot without worrying about hitting high rates of inflation again, because it's going to be very difficult to make wages move higher. I mean, first of all, 9.5 million fewer Americans have jobs now than they had in February last year. So we've got practically 10 million people out of work who were working a year ago. And even when all of those people were working, the unemployment rate was at a 50-year low. It was 3.5%. That was the lowest it had been since the 1960s. And still, there was very little wage inflation and even less inflation at the core PCE level. I think wage growth hit the highest it had for decades about a year and a half ago at 3.8%. That's the highest wages ever increased, even at this extraordinary boom that we had with unemployment down to a 50-year low. Wages still weren't going up. So first, we have to re-employ the 10 million people who've lost their jobs because of the pandemic. And then, even then, that doesn't assure there will be any wage inflation, because we still have a whole world full of ultra-low-cost labor to employ outside the United States. We don't have to pay the US workers more than the companies don't. They haven't in the past. They're not likely to in the future unless something changes. So that's why there's such low inflation at the CPI level, at the consumer price level.
Right. And it's kind of like, sure, the inflation that's working its way through our system through liquidity may increase a percentage increase, but it's being fought by someone who is potentially willing to work for, let's say, 80% less than a US worker. And so that's what's taking place in a macroeconomic kind of level. But you bring up a good point about the amount of unemployed people currently. I mean, there are huge sectors of the economy, and most importantly, the service sector, where they've been closed down. I mean, 75% of the businesses, of the restaurants in Los Angeles, for example, are closed down, many of them permanently. What do you think that means in terms of additional stimulus and in terms of the implications of that as it relates to bank reserves or otherwise?
Okay, well, so looking ahead for the next few months, it is likely that the inflation rate is going to pick up, perhaps quite noticeably. But the main reason for that is in April last year, when the pandemic was doing its worst in terms of the economy, the price level fell. Prices plunged. And so when we compare prices in April this year with prices in April last year, they're going to look considerably higher. And that's going to spook the markets to some extent. People are going to say, look, inflation is moving up, and therefore bond yields should move up, or perhaps the Fed should tighten monetary policy.
Right.
And also, in addition to that, we're seeing a lot of commodity price inflation right now. Commodity prices are wildly volatile. They move up radically one year and then they fall radically the next year. That's why the Fed tends to ignore the commodity price inflation, because it's just too volatile. Just one example. In June 2008, before the bubble popped, commodity prices were up 40% year on year. But 9 months later, they were down 53% year on year. So right now, they're up about 13% year on year, and they're going to keep going higher for some time because of all of this stimulus and the vaccines rolling out. People are going to go out and spend money. So that will drive commodity prices higher for some time. But the Fed is going to look through that. The Fed has made a very important change in its operating procedure that it announced in August last year. It said that, look, in the past, we targeted 2% inflation. And anytime we looked into the future and we thought that the economy was getting too hot because the unemployment rate was falling too low, they acted preemptively. Back in 2004, when the unemployment rate fell to 5.5%, that's when the Fed started hiking interest rates again. And then more recently, when the unemployment rate fell to 5% in the most recent cycle, that's the last time the Fed started tightening interest rates, hiking the federal funds rate. But both times, the unemployment rate kept falling and falling and falling, and we still didn't have any inflation at the CPI level, at the consumer price level. And so, as I mentioned before, last time, a year ago, the unemployment rate was down to 3.5%. And the inflation rate peaked at 1.6%. So they said, look, that was a mistake. We're not going to hike interest rates preemptively anymore because that slows down the economy unnecessarily. It means people who could have had jobs or wage increases didn't get them. So from now on, we're not going to hike preemptively. We're going to wait until we actually see inflation numbers printed in front of us that inflation has moved higher. And then we'll act once we really see this. And the second part of that announcement was they also said that since they had undershot their inflation target for decades, they want to have 2% inflation, and they haven't. So they said, from now on, we're going to target an average of 2% inflation over the long run. And what that means is that they're going to allow the inflation rate to move above 2% for some time. As I mentioned, for decades, it has been below 2%. So what this means is that even when core PCE inflation moves from where it is now, 1.5%, if it moves up to 2%, the Fed's not going to hike. They haven't been exactly clear on when they would hike, but we can imagine it moving to 2.5%, even 2.8% perhaps, for months, if not even a couple of years before they would respond. The Fed has told us again and again in every speech they make and in their press conferences that they're not going to tighten until they see real evidence that inflation has moved significantly higher and above 2% so that it will average 2% over the long run. And if it moves temporarily over, and they think that this is due to just transitory factors, such as a boom in commodity prices, they're going to look through that. They want to see higher levels of inflation and higher on a sustainable basis, and so that it averages 2% over the long run. So the Fed is not going to hike anytime. They're not going to tighten monetary policy this year. They're not going to end quantitative easing. This is going to go on at $120 billion a month until the end of the year, at least, and probably well into next year. And they're not looking at increasing the federal funds rate until probably 2023. So we're looking at a period of extremely loose monetary policy for the foreseeable future. And in the near term, we're looking at massive fiscal stimulus as well, with the $1.9 trillion recent rescue bill passed. So this is going to rev up the economy, and it's also going to cause the US trade deficit. become very much larger, which will mean that the spending that happens in the United States is going to benefit the rest of the world as well. But this, as the trade deficit becomes larger, it's sort of the escape valve or the mechanism that will ensure that inflation in the US doesn't move up too high. So it's almost certain that as the Americans spend their stimulus checks, they're going to buy more iPhones made in China, and the US trade deficit with China, for instance, is going to become larger. And the trade deficit with all the other countries that we do trade with is also likely to expand, which will benefit their economies. China is actually worried that they're going to be flooded with too much money from abroad and cause their economy to overheat even more than it's already overheated.
Yeah, and I agree, by the way, regarding the Fed outlook, that those comments are extremely consequential. That is a drastic shift, and I don't think enough people are paying attention to it. When it's challenging to hit that 2% inflation rate already, and they're saying this is a new policy, this is a new lens through which we're viewing this topic, which is that we will allow inflation to run to this target, and through this target, that changes things drastically. So when you have all this liquidity pumping through, you can make the argument, and I have heard people recently make the argument, listen, this is basically a multi-trillion-dollar boost to the stock market, to real estate, et cetera. I'm going to put a question I have for you on bonds to the side for just a moment. But I've heard this argument be used in the way of which if something goes wrong, if there's a panic crash, if there's a, hey, stock prices are too high based on historical standards in terms of, let's say, profits per share or earnings per share, et cetera, that can't happen. We can't have a 30% correction because there's $1 trillion floating around looking for returns, looking for yield. Can you walk us through how that could happen? How it could be the case that you can have all this liquidity and potentially, especially a short-term crash in the market and potentially the real estate market as well?
So yes, we're beginning at a point where there is already a speculative frenzy going on in the stock market in particular, and the property market also. U.S. home prices are up practically 15% year on year. But of course, the stock market is much more sensitive, much more wildly volatile than the property market tends to be. So it is possible that the market is already nervous, and they're nervous in particular because the 10-year bond yields have been moving up so quickly. And so it's not at all impossible that the markets would be hit with a panic attack and have a significant sell-off. Now, this is even despite this liquidity. Of course, there's a lot of liquidity. That doesn't mean that people are necessarily going to take this liquidity and buy stocks with it. But they always have the option of just putting the cash under their bed and waiting. So liquidity by itself doesn't guarantee the boom, but it generally ensures that there is a boom because most people are too tempted to take the money out from under the bed and speculate with it. But yes, so there could be a big sell-off. And it's very interesting now because I would say for probably going back to 2008, the Fed has been very sensitive to the level of the stock market. And that's because the Fed really needed the stock market to go up to create a wealth effect to help drive the economy. It was really counting on the stock market going higher. And the main reason for that, I think, is because in the past, before 2008, the economy had become dependent on credit growth. It really grew because credit was growing so rapidly. And in fact, it became addicted to credit. I'd say our system evolved from capitalism into creditism because credit growth became the main driver of economic growth. And we saw between 1950 and 2009, anytime credit grew by less than 2%, adjusted for inflation, the US would go into a recession. And it didn't recover from the recession until there was another big surge of credit growth. Well, in 2008, the private sector was so heavily indebted, they couldn't take on any more debt. And after 2008, the credit was just barely growing at 2% a year, adjusted for inflation, even with all the debt the government was taking on. So credit growth was too weak to drive the economy. So the Fed attempted to supplement the credit growth with asset price inflation. And they, through a combination of extremely low interest rates and round after round of quantitative easing, they pushed the stock market higher. And anytime the stock market started to drop, the Fed would immediately loosen monetary policy. I came to say that the Fed was a hostage to the S&P Because anytime the stock market threatened to go down, the Fed would pacify it one way or the other. Whether that at one point they were doing quantitative tightening, the stock market in December 2018 fell 20%. They said, okay, we're going to stop doing quantitative tightening. And not long after that, in 2019, in September, we had another problem, and they relaunched quantitative easing just 4 months after they'd stopped quantitative tightening. So the Fed was really counting on, it needed stock prices and asset prices to keep going higher. Well, now it's interesting because we're going to have so much economic stimulus this year from the fiscal side, government spending, that it looks like we're going to have the kind of economic growth we haven't had since President Reagan tripled the government debt in his administration in 8 years. All of the credit that he created a big economic boom during the 1980s. The government debt tripled under President Reagan in just 8 years. And that created a big boom. The economy grew, I don't know, at one point, I think above 6%. And that's the sort of boom that we're going to have this year, it looks like. And so now I wonder, it seems perhaps the Fed is no longer as dependent on asset prices as it was before. Before, the Fed was a slave to the stock market. If the stock market threw a tantrum and dropped 10%, they could count on the Fed to come to its rescue. Well, I wonder if that's still the case now. The asset prices are already so inflated, and we see these crazy things going on in the stock market with the Robinhood gang and all of the SPACs in so many respects. The PE multiples are historically high levels, and you have to wonder, perhaps the Fed would welcome some 10, 15% correction in the stock market at this point. And because it wouldn't matter so much if we had a contraction in asset prices and in wealth at this point this year, because we can be certain that the government spending, these enormous stimulus bills, are going to make the economy grow by 5 or 6 or 7% anyway. So the markets have been a little bit surprised that, well, first of all, the 10-year government bond yield is enormously important for the stock market. And it's moved up very rapidly, much more rapidly than I think anyone had anticipated. At the beginning of this year, the 10-year government bond yield was less than 1%. It was 93 basis points. Well, as of yesterday, at the peak, it had gone up to almost 1.75%. And that has really surprised people how quickly that's moved up. And that's one of the reasons that the highest flying NASDAQ stocks have become so volatile and have had some meaningful pullbacks.
Can you explain that real quick? The correlation between those two things and why the increasing the bond prices has created that boom, particularly in NASDAQ?
Well, yes. So when interest rates are very, very, very low, that means that individuals can borrow money almost for free. So if you can borrow money for free, then borrow it and speculate with it, and everybody follows suit, and the most speculative stocks go up the most. But once the cost of borrowing money starts to inch higher, then money is not so free anymore. And the more expensive it becomes to borrow money, the less attractive these very speculative investments become. And that's why the high beta stocks, or the most risky stocks, tend to sell off the higher the interest rates go. And also, this applies to gold as well. Once the 10-year bond yield started moving higher, we've seen gold pull back quite significantly in the last couple of months because gold doesn't pay any interest. Now, if you can buy a 10-year government bond that pays, say, 2% interest, then the opportunity cost of buying gold has moved up to 2% interest a year. And so the higher the 10-year bond yield goes, the more likely it is that gold prices will fall. So the markets have been surprised that the Fed, that Jerome Powell, hasn't done something to stop the bond yields from going higher. The market has been waiting for Chairman Powell to say, we're uncomfortable with the bond yields moving up so quickly,
right,
and we're going to stop that from happening. Now, everyone needs to understand that the Fed can control the 10-year government bond yield at absolutely any level it chooses. And it's buying $120 billion worth of bonds every month right now. If it decided that the bond yields have moved too high, they're now 1.7%. If they decide that's too high and they want them to be no higher than 1.3%, for example. Or let's just make this simple. They decide they want the bond yield to be 1%. They could make an announcement that instead of buying $120 billion worth of bonds this month, they were going to buy $250 billion worth of bonds this month. And by buying bonds, that pushes up their price and that pushes down their yield. And so they could drive the yields lower. Or they could be even more precise than that. They could say, we've decided that we want the 10-year government bond yield to be 1%. And therefore, we're going to buy as many bonds as necessary for as long as necessary to push bond prices up and to push the bond yield down precisely 1%. And we're going to hold it there until December 31st. And when we change our mind, we'll let you know when we're going to stop doing that. That would be called yield curve control. And that's what Japan has been doing since 2016. So the Fed can control the 10-year bond yield at any level it chooses. A good example of this was in Australia just about a week or two ago. The Australian central bank was concerned that the bond yields there were moving up too quickly. So one day they bought twice as many bonds as they typically did in a day, and that pushed the bond yield down by 25 basis points. So the central banks can control the bond yields. So the markets have been waiting for the Fed to make some sort of announcement like that they were going to intervene and keep bond yields from going higher. But the Fed has not made that announcement. And so this has surprised the markets and created more nervousness in the markets and some sell-off, particularly in the high-flying NASDAQ stocks. And you have to wonder, maybe the Fed welcomes this correction now because there is such a speculative frenzy going on, particularly given that they understand this wave of liquidity, this liquidity tsunami that is hitting the markets over the next few months could potentially drive asset prices just to astronomical levels. So they might welcome some pullback now just so that this liquidity tsunami doesn't carry the markets just completely out of control. Because sooner or later, of course, wildly overinflated stock prices will correct. And if they become really an enormously large bubble, if the bubble pops, it can destabilize the financial system and the economy. The Fed doesn't want that. So it's very interesting to see what's going on this year now that the Fed is no longer beholden to the stock market to make the economy grow.
So this is a question that I've been contemplating, and I have seen people use the same data points to paint the opposite picture and to come to different conclusions. So I'm very interested in where you stand on this. When I imagine, let's say, a German private equity group, pension fund, government entity, et cetera, Japanese same, with $1 billion under management, and I'm looking at US bonds with a positive yield, and if I have the ability to allocate funds to US bonds, I feel like I'm going to purchase US bonds, drive prices up, drive yields down. And that's where I see this liquidity coming. I made this argument that the increase in liquidity does not mean that rates are going to be going up, but that the global demand for yield is so strong, and the United States bonds in particular are positive, and in the industrial world, that's rare, if not completely unfounded otherwise. Am I making a coherent argument there?
Yes.
Or is that same argument just the opposite of that, where people say, because of all this liquidity, there's going to be an incredible run-up in stock prices and a flight away from bonds? I'd love to get your thoughts on that.
No, I think you're making a very good argument. A different way of looking at this is that because every country's balance, you use the example of Germany. Well, Germany and China and all of our other trading partners not only have the stock of money that they have right now, but they're going to have a whole lot more dollars over the next year because of their trade surplus with the US. Right now, the US current account deficit is running at an annual rate of about, in the most recent quarter, at an annual rate of about $700 billion a year. And it's going to grow much larger as the stimulus money is spent. So that means $700 billion are being sent overseas, let's say over the next 12 months. So that means these foreign countries are going to accumulate $700 billion. And once they have the dollars, they need to invest them in US dollar assets. And their favorite asset is US government bonds.
Of course.
So a more technical way of describing that is every country's balance of payments has to balance, just like a family. The country is like a family. every country's budget, every family's budget has to balance. If they spend more than they earn, then they have to borrow something from abroad or sell something. And it's the same with the country. When we have a $700 billion current account deficit, that means by definition, we will have $700 billion of capital inflow into the country from abroad. And so the balance of payments has to balance. So the larger the current account deficit becomes, and it's going to become much larger, the more money we'll have coming in from abroad. And that money, a lot of it is going to go, well, it goes here, there, and everywhere. It goes into government bonds, it goes into stocks, it goes into property. Money is fungible. It really doesn't matter where it hits initially. It gets spread out all around the economy. So that's one reason that we may see bond yields not go higher, because if this foreign money goes into government bonds, then that's going to tend to push up the bond prices and push down the bond yields, just like quantitative easing does. We've been talking about quantitative easing and the liquidity tsunami just up until the middle of March, until the middle of June this year. That's our earlier discussion, into the middle of June. But if QE continues at $120 billion a month during the second half of the year, 6 more months to December, that adds another $720 billion of liquidity to the banking system, just from the quantitative easing alone. So it is possible that all of this liquidity, both domestically generated and coming in from abroad, could push the bond prices higher and the yields lower. So there's a real battle going on now. On the bullish side is this extraordinary liquidity that the economy is being hit with. On the bearish side, there are fears of inflation expectations. People are afraid that inflation is going to go higher, and therefore they're less willing to buy a government bond at a low interest rate. And so they have been reluctant to buy government bonds, and so the bond prices have been weak and the bond yields have been moving higher. And the higher the bond yields go, that spooks the investors in the stock market and causes nervousness there. So there's this real battle going on between fears of inflation on the one hand and liquidity on the other. And that's why we're likely to see a lot of volatility over the months ahead. But I suspect that in the end, we're going to see the liquidity win out, because we're probably not going to have very meaningfully higher inflation rates on a sustainable basis for the reasons that we discussed before. We have a global economy, and it's going to be a lot of unemployed Americans to start with. It's going to be hard to get wage inflation moving higher. And without wage inflation moving higher, it's going to be hard to imagine inflation moving higher on a sustainable basis for very long.
Agreed. And the economic inertia, which from in completely ahistoric manner has been stopped and is now starting to be restarted. It's a very interesting situation. We don't have a lot of examples, especially from a big picture global perspective. So if I'm a real estate investor,
let me add something else before we go there. There's another really important, very, very important factor that we haven't discussed yet. So the government has now passed the $1.9 trillion stimulus bill, but they've already started talking about an even larger infrastructure bill. We don't know if that will ever be passed, or when it will be passed, or how large it will be, and how much money would be spent every year. But there seems to be a significant chance that there is going to be a very large infrastructure bill coming next. And they're talking in a range of $2 trillion, $3 trillion, $4 trillion. So, of course, this is going to have profound implications for everything as well. If that sort of money were spent just in a very short period of time, then, of course, that would create more inflationary pressures. But it's going to be spun out over a number of years. But so this is going to be fascinating, because what we're seeing is really a fundamental paradigm shift in the way the U.S. economy is being managed. We're moving away from a long period of austerity of sorts, where government investment was looked down upon and frowned upon, to a new period, perhaps, where we realize that we've gone too far in that direction. Our infrastructure is falling apart. We're being overtaken by China in technology, and China's become a grave national security threat to the United States looking out 10 years. And this is because the US government has invested too little in research and development in recent years compared to what it was investing as recently, for example, as the early 1960s, following the Russian Sputnik scare, when it appeared that Russia was going to overtake the United States technologically because they were the first to send a satellite up. Well, the government responded to that by much larger investment in R&D, and that spurred economic growth and created all kinds of technological advances and generated good economic growth. But then, as time has gone by, the government has invested far too little now in research and development and in infrastructure and in everything else. So it looks like the pendulum now is swinging back potentially in a very big way. And if what we discover is that the government can, in fact, have these very large stimulus bills and these very large budget deficits without creating high rates of inflation, then I think we can expect to see more of this. Initially with a big stimulus, a big infrastructure bill, which could rebuild the country's infrastructure and create a lot of good paying jobs, hopefully in the United States. And following on from that, more government investment in research and development. In his campaign, then candidate Biden published plans to have not only a big infrastructure spending program, but also he pledged to invest $300 billion in government investment in research and development. Now, $300 billion is not enough. It's far too little, but at least it's a recognition that more needs to be invested. And so if we find that we can spend the sorts of amounts that we're spending now and get away with it without significantly higher rates of inflation, it's likely that we're going to move into a very different kind of economic paradigm than we've experienced for the last many decades, involving much greater government investment, much greater government spending. And that's going to fundamentally change the structure of the economy and the way the economy works as well. And if we can get away with it without having high rates of inflation, then everybody's going to be very much better off. We'll not only have better infrastructure, but we'll also have greater national security because we won't be overtaken technologically, economically, and militarily by China, as we will be otherwise in very short order.
So last time Richard was on, I believe the last one or the time before, actually the time before, we went very deep into that particular topic. So make sure to check out that interview in the show notes page. About half of it is on the discussion of government investment.
And before, people would always say, do you really think anything like that could ever happen? But now it's increasingly clear that something like that can happen. And it's becoming much more of a probability than a possibility now that we've seen what the government can spend through this pandemic. So we'll see. So we are moving in that direction.
Yeah, I agree.
I think that's the healthy direction in which we should move if we want to remain a powerful and independent nation.
Yeah, I think that is certainly the direction that's going to take place because it grows on itself. And if you can provide capital to one research and development project, you can provide it to two. And I don't think this is going to change, especially given the reality of this inflation situation when you talk about the negative downward pressure on deflation versus inflation. I got to ask you a question about real estate, though, because obviously it's a real estate show. So looking at this right now, I think a lot of people are making the argument this is a great time to sell real estate. Now, you can lock in low rates for sure, but you also have this great opportunity to sell and look and go to a buyer and say, look at these great low rates. You can overpay. You can lock in this. But the question is, it may also be a great time to buy, but what happens 5 and 10 years down the road? I think a lot of people are concerned about inflation. We've addressed that concern, but they link that concern with increasing in rates. So if rates, people look at them and they've heard for a decade now, when are they going to return to quote normal, whatever that means? And if they do go to, let's say, 5% or something like that, what's that going to do to housing and all these types of questions? Can inflation increase indirectly through the Fed interest rates? And also, can it be the case that rent can be increased and therefore the implied cap rates based on our original purchase price can increase significantly proportionately, meaning that are we going to get burned playing this game where we're in a very low interest rate environment now, then all of a sudden all this liquidity works its way not only through the financial sector, but into the world of core prices. And then all of a sudden we don't have this delta between interest rates and cap rates, and people are trying to sell in an environment where prices may be far less inflated.
So it is possible that property prices could fall. And if interest rates move significantly higher, I'm sure that property prices would fall for some period of time. But for me, I think investing in rental property as a long-term investment, and it has to be a house sitting on a piece of land. I'm not talking about investing in condos or anything else. Just for normal Americans, in my opinion, a good, safe, long-term investment that you can control yourself without having to worry about other people managing it and stealing, or accounting fraud, something that you can manage yourself. It's now possible in the United States, to borrow a mortgage, a 15-year fixed mortgage rate. It's still very close to historic low levels. You can lock that money in for 15 years at very low rates and buy a house on a piece of land, rent that out, and pretty much over a 15-year period, the rental income will pay for what you have purchased the house for. And after that, you have free, eternal cash flow forever. And meanwhile, on the one hand, if we have high rates of inflation, then the value of the land is going to appreciate, just like gold will appreciate. But on the other hand, of course, it is possible that if we had very high rates of interest rates, then the property prices could fall, but you would still have the rental income. Now, of course, you have to be aware that your rents in a severe environment could have to be cut. You might have to cut your renter's rent for a period of time. So you have to be careful how much leverage you use when you invest in a rental property. But over the long run, for young people, especially if they want to ensure a prosperous retirement, they need to, a very good strategy would be to start accumulating rental properties. And as quickly as you can, investing in rental properties. I think that's a very conservative, long-term strategy. It's extremely conservative compared to the approach taken by Robinhood investors, for instance.
Sure.
You're not going to get rich overnight that way, but you're probably going to become wealthy by the time, we're talking several decades down the road.
Yeah, I appreciate you sharing your perspective. Richard, this has been an excellent conversation talking about liquidity, inflation, the potential increase or potential long-term decrease in rates. I really appreciate coming on, as always, and just going into this level of detail. Before we jump off, let the listeners know how they can learn more about you, your newsletter, and anything else you want to link to.
Okay, good. Thanks, Hunter. It's always a pleasure talking with you. So I produce a video newsletter called Macro Watch. And every couple of weeks, I create a new video. It's essentially me making a PowerPoint presentation about something important happening in the global economy. For instance, over the last 3 weeks now, I've actually done more than I normally do, but I've done a lot of presentations on the outlook for inflation and also this liquidity tsunami. One was called, Will the Liquidity Tsunami Drive Asset Prices Much Higher, or something like that. So with Macro Watch, as I mentioned earlier on, the economy just simply does not work the way that it used to back when dollars were backed by gold. It works in an entirely different way now in the 21st century than it did before. The problem is the economic textbooks still teach classical economic theory as it was first written in the 19th century. And in the 19th century, there were constraints. And the main constraint was money was gold. And that dictated everything else that happened in the economy. Well, money is no longer gold anymore. So you can throw all of those economic theories out the window because most of them just simply don't work anymore. They do not apply to the world in which we live. And so in Macro Watch, I explain the way the world really works now, what drives the economy now. And what drives it is credit growth and liquidity. And if you can forecast accurately credit growth and liquidity and the factors behind that, which are largely government policy, then you have a very much better chance of being able to anticipate what's going to happen to your investment portfolio, if that's the thing that interests you most. So I focus on how developments in liquidity and credit growth are likely to impact stocks, bonds, commodities, currencies, and interest rates. So I hope your listeners will visit my website, which is richardduncaneconomics.com. That's richardduncaneconomics.com. And if they would like to subscribe to Macro Watch, click on the subscribe button. They will be immediately prompted to put in a discount coupon code. They can subscribe to MacroWatch at a 50% discount. And they will then have immediate access to all of the MacroWatch videos in the archives, probably 75 hours of videos covering everything in the global macro environment that you would like to know about. But also an additional, they will receive a new video approximately every 2 weeks for the next year. So I hope they will visit the website and take a look around and subscribe to MacroWatch if they would like to, or at the very least, while they're there, they can sign up for my free blog and they can follow my work that way.
Amazing. Appreciate it, Richard. Always a pleasure. Thanks again.
Hunter, okay, thank you. Let's do it again before too long.